Hello, everyone. I'm Matt Clark, research analyst for Money and Markets, and joining me as he does each and every week from lovely Peru. I assume it's lovely. I've not been. I'm hoping that he'll fly me down at some point in the near future. But Greens and Fortunes co-editor Charles Sizemore, London School of Economics prankster as well, and he is with us. And today, Charles, I'll jump right into it. It's that time of year, and it's the time of year that everybody dreads. Well, most everyone. There, some people actually don't dread it; they look forward to it. But everybody dreads
March Madness.
No, well, if you looked at my bracket, you'd see the dread all over it. Although my projected champion still in the mix. So, however, it is tax season. It is a time where everyone starts looking at their 1040s. They start logging into their respective online tax preparing service or whatever, and they start, or if you're like me, you start kind of doing the math in your head and comparing that to tax tables, thinking, okay, how much am I losing or how much am I gaining this year before you actually file? But filing coming up in another month or so, and now's the time where people start to look at it. And I know you have a very good background in terms of taxation and economics and fiscal policy, things like that. So I guess I want to jump right into it. And people are having taxes front of mind, especially with things like inflation, higher costs of goods and services, including gas. And lots of other things, all weighing in on the entire fiscal picture of a household. Taxes is just one of those things that just wrong place, wrong time at this point. So what if you're just an employee? I mean, you and we're just employees of a company. What can we do in terms of taxes to not only prepare? I think that's kind of a given, but also maybe try to utilize some potential relief here, because taxes can be a very, very rough time for a lot of American families.
Well, every dollar you pay in taxes is a dollar you no longer have to spend. So that is how that goes. It's clearly in your best interest to keep every one of those dollars in your possession and not give it away. But so there's a couple different angles here. But one is, okay, tax filing deadlines coming up in April. What can you do now for last tax year? What can you do now for tax year 2021? And the short answer is, unfortunately, not a lot. Yeah, really, the time to do most of your tax planning for next year is now. You really have to plan months in advance. But there are still a few things that regular Americans can do to at least save a little bit on taxes here. And one is, if you have not done so already, you can contribute to an IRA. Now, that does get a little bit tricky if you already have access to a workplace 401k, but depending on your situation, you may still be able to put some money into an IRA and at least save a little. But one really kind of underappreciated way to save on taxes, one that a lot of people don't think of, and a lot of financial planners forget to mention it, is the health savings account. So the health savings account, this is a Charles Sizemore original. You're not going to find this term in the financial textbook or any book on financial planning, but I call an HSA a spillover IRA. Again, not a legal term. Don't this is not, you're not going to find this in the Wall Street Journal. But why do I call it that? So if you've already maxed out your IRA, your 401k, all of your usual alphabet soup of financial retirement accounts, and you still want to put more money away to get that tax break, the HSA is really, it's your next thing. Now, the HSA is different than an IRA. They are not interchangeable, but depending on how you structure it, how you use it, you can kind of make it a de facto IRA, if you will. Now, the rules: when you put money into an IRA, you can't touch it until the age of 59 and a half without taking a penalty. So you can take the money out. It's not that you put money in an IRA, it's off limits. You can take it, but you'll pay a penalty and any taxes due for doing so. The HSA is a little bit different. If you put money into an HSA, you can take it out tomorrow if you use it for health expenses. Now, if you're using it for any purpose other than health expenses, you will pay a penalty and you will pay taxes. Now, the exception is if you wait until you're over the age of 65. Why 65? Why not 59 and a half like the IRA? I think it comes down to Medicare. Once you qualify for Medicare, you don't really need the HSA anymore. So the IRS allows you to just take the money out the same way you would take it out from an IRA. So it's a little bit different than an IRA in that the ages are different, the rules for taking it out are different. But at the end of the day, if your purpose here is, I want to get as much money out of the taxman's hands as possible, I want to get that tax deduction now this year, and I would like to perhaps invest it going forward, then that HSA, it's the next best thing.
Okay. Now, where things get a little tricky, and I know there's limits in terms of contributions to each one of these. I'm looking at some notes here. Roth contributions, you've got about a $6,000 limit per person, $7,000 if you're over the age of 50. 401k is another thing, and your spillover IRA, your HSA. I believe that if I remember reading what you wrote me correctly, annual contributions for HSA, the limit is about $3,600 for self-only insurance and $7,200 for a family plan. Correct?
It is, and that also brings up another point. In order to contribute to an HSA plan, you have to have a high deductible health insurance policy tied to it. Now, these days, pretty well everybody has a high deductible. I don't know anybody that doesn't have a high deductible health insurance plan at this point. And if you're one of those lucky people that actually has a great insurance plan with low deductibles, I'm gonna kill you. No, I'm joking, but it's
that's bold, man. That's really
jealousy speaking. No, that's just the market we're in now. Most people do have most people do have a high deductible health insurance plan these days. That's just the nature of the beast. So you should talk to your HR department. You should talk to if you're self-employed and you don't have an HR department, you should talk to your insurance representative, but they can tell you whether or not the plan that you're currently in allows for an HSA. And if it does, that is a really nice last minute way to save on your taxes.
Now, you say there's a high deductible. Is that a subjective state by state type of a definition, or is there a broader, if your deductible is X for either a self plan, a family plan, or maybe a self and spouse or whatever? Are there limits that are guidelines already set forth in that, or is it kind of a state by state type of a situation?
The easiest way to know on that, just ask your HR rep. The rules are muddy. It's insurance, man. It's always murky and complicated. So the easiest way to get a definitive yes or no answer is just talk to your HR department.
Okay. Now, where things get a little bit tricky is when we start talking about the gig economy, which is what we're in. And you have a lot of people that are utilizing this gig economy. By gig economy, I mean, working from home, having side hustles, Uber, Lyft, DoorDash, these types of delivery services, all these other types of independent contractor type jobs that are secondary to your primary source of income. And millions of Americans are doing it. It's pretty widespread at this point. How do the tax rules apply when you start talking about either being self-employed or an independent contractor, or looking at that secondary side hustle type income?
Well, there's good and there's bad. I mean, the bad is that when you're getting 1099 income or side hustle income or whatever, you're generally not withholding on that. So you really have to plan ahead. Ideally, you're making quarterly estimates to the IRS, or at the bare minimum, you're putting some money, just putting it away in an account ready to go, because that can be a nasty surprise at the end of the year for a lot of people. But that's the bad. The good is, oh my goodness, the things you have at your disposal as a self-employed person or as a gig worker, whatever you want to call it. You have this whole new suite of options available to you for retirement planning with much higher limits. You could do a SEP IRA. You could do a solo or individual 401k. You could, and by the way, this doesn't, your ability to do that isn't limited by your employer plan. Let's say you have both. Let's say you have a regular 9-to-5 job, you have a 401k there. You can actually create a retirement plan for your side hustle income as well. Now you have to keep the overall limits. You have to keep track of this. You can't. It is possible to over contribute to plans. So you have to keep them not speaking well. What I'm trying to say is, if you max out your employer plan, you put the full 20,500 into that, then you do have to be careful what you do with the side hustle plan. With the side hustle plan, it's profit sharing. You could put about 20% of your earnings into a separate retirement plan, be it a SEP IRA or a solo 401k, in addition to what you're doing with your employer. So that's, if you're wanting to really ramp up your savings, you can put up to $58,000 into these kind of plans.
I see. So anything else? I mean, I know that, the time to work on, 2021 taxes is pretty well done. I mean, there's really not a whole lot that can be done. But looking ahead now to 2022 and even beyond, now's the time to really set those things in place. Is there anything else that, people need to be aware of? I don't want to, try to encourage you to get out of taxes, but I mean, we all want to try to reduce.
No, but you should. You should encourage people to legally reduce their tax bill. Obviously, don't do anything dodgy, but the IRS makes rules and they expect you to follow them. And if you follow those rules, you can actually save yourself a boatload in taxes. So I would say this: the best time to plan is, of course, yesterday. You should always be planning ahead, but if you haven't yet, it's actually not too late. If you had side hustle income, you still can shelter part of that with a SEP IRA, for example. It's not too late for that. If you have access to an HSA account, you can still put money into that. So there's a lot of things you can still do, of course, though, for in order to do it right, in order to really fully maximize this, of course, it's beneficial to start early. If the earlier you start, the more time you have to save. It doesn't all come out of your checking account in one big, one big check. You can space it out over 12 months. Clearly, it makes your life easier if you start early. But if you're really looking for some last minute tax savings, try these. Like it's not too late.
So you got a SEP IRA, you have a health savings account. Of course, obviously a traditional Roth IRA or 401k, if you're not participating, obviously helps as well. But the time to start planning for that for this tax year we're in now, not 2021, 2022, is now. He is Charles Sizemore. He is the co-editor of Green Zone Fortunes. I'm Matt Clark. I am research analyst for Money and Markets. Do make sure you check out moneyandmarkets.com. It is your home for safe, sound, smart, simple, profitable investment information for your portfolio. Charles, myself, Adam O'Dell, our entire team, we work to give you that information 7 days a week. You can sign up for our free daily email and get all that information sent to your inbox for free every single day. And while you're at moneymarkets.com, use our Green Zone rating system. You can type in the ticker or company name for thousands of companies and get our proprietary Green Zone rating system. We rate stocks, thousands of stocks on using 6 different metrics, 3 fundamental, 3 technical. We give it an overall ranking. We let you know if we're bullish on it, if we're neutral, if we're bearish on it, let you know kind of what, if you're looking at that as a potential investment, maybe what you should be looking at. Plus you have access to stock charts, fundamental data, any research we've done on these particular companies is all right there at your fingertips. Start your own watch list as well. Maybe you want to track some stocks, kind of see how they do over the course of time before you invest. Or maybe you already have a portfolio and you kind of want to see how they do in a secondary source, then moneymarkets.com is certainly the place to do it. If you have a question about a stock, the broader market, the economy, saving money, anything like that, and you want to reach out to myself, to Charles, or to Adam, you can do so. Email us. The email address is feedback@moneyandmarkets.com. We'll put that right down there. Or you can comment below on our YouTube channel. We love to read all your feedback. If you do send us a question and we use it, we're going to send you some very cool Money and Markets gear. We've got t-shirts, hats, sweatshirts, all sorts of stuff. This t-shirt right here, like what I'm wearing. We can't get Charles his in Peru because we just can't get it to him. He's hiding somewhere. So we can't get it. It would take a
really long time for the llama cart to get here.
That is also very true. So you have a chance to get that again. If you email us, feedback@moneymarkets.com, that email address down there, and also comment below on our YouTube channel. Got a lot of great stuff, more coming up this week. So make sure you stay tuned. I hope everyone has a great week. Charles, any parting wisdom in terms of tax season?
Well, as we said, it really comes down to planning. So the earlier you can start planning, the more you can save.
He is Charles Sizemore. He is the co-editor of Green Zone Fortunes. I'm Matt Clark, research analyst for Money Markets. Until next time, everyone, safe trading.